Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Tuesday, September 16th. In a surprise move for Fed funds futures traders, the Federal Open Market Committee agreed unanimously to leave the Fed funds rate unchanged at 2%. The discount rate was also left unchanged at 2.25%. Prior to the decision, the Fed funds futures market priced in an 88% chance of a cut in the Fed funds rate to 1.75%. The statement itself offered some new wording versus the prior directive, although the general tone was still the same in that the FOMC said both the downside risks to growth and the upside risks to inflation are of significant concern to the committee, and that it will act as needed to promote sustainable economic growth and price stability. The unanimous vote, however, connotes some relief on the inflation front, which is understandable given the collapse in commodity prices, the strengthening in the dollar, the drop in capacity utilization, and the weakening in the labor market. In prior meetings, Dallas Fed President Fisher had been a vocal proponent of raising rates to combat inflation. This announcement is striking not so much for what it says, but for what it does not say. In light of the recent upheaval in the financial sector, it was presumed the FOMC would provide some language that offered a stronger indication that it is inclined to cut the Fed funds rate. In turn, there was some thinking that some other approaches for injecting liquidity in lieu of a rate cut might also be announced. In part, the relatively calm assessment here reminds us of the Fed's approach last December when it disappointed the market with a 25 basis point cut when participants were hoping for a 50 basis point cut. As it turned out, the Fed wasn't done there. It returned the following day with an announcement that it had worked out a coordinated effort with other central banks to inject liquidity. How the credit market responds in the wake of today's decision will likely influence the Fed's thinking on the necessary course of action over the near term. For now, though, the lack of a move when one was widely expected by Fed funds futures traders might be seen as the emergence of a sterner Fed that isn't inclined to cater to the wishes of traders. That stance certainly fits with the recent decision not to bail out Lehman Brothers, although it remains to be seen what will happen with insurer AIG. Recent news reports suggest the Fed might still be open to a loan package for AIG. For the time being, though, it can be said that the Fed acted in a manner for a change that was not consistent with the market's thinking. I'm Pat O'Hare for Briefing.com. Thanks for listening.